Hi, my name's Richard and I'll be talking with Tom and Sam today, and this is our market view presentation. The objectives of our presentation are the discussion of the 6-month exchange rate forecast for the AUD USD and AUD Great British Pound. The discussion of interest rates, inflation rates and official intervention will make up the majority of our talk. Interest rates are primarily made up of inflationary expectations and the central bank action. However, interest rates, inflation and exchange rates are all highly correlated. By manipulating interest rates, central banks exert influence over both inflation and exchange rates, and changing interest rates impact inflation and currency values. The central bank in Australia is the Reserve Bank of Australia, or RBA. Higher interest rates offer lenders in an economy a higher return relative to other countries. Therefore, higher interest rates attract foreign capital and cause the exchange rate to rise. The impact of higher interest rates is mitigated. However, if inflation in the country is much higher than in others, or if additional factors serve to drive the currency down, the opposite relationship exists for decreasing interest rates. That is, lower interest rates tend to decrease exchange rates. Traditionally, increasing interest rates would see an appreciation of that country's currency. More realistically, higher interest rates lead to a depreciation of a currency's value. Over the next 6 months, the Australian interest rate is predicted to remain steady due largely to the behaviour of the RBA. The RBA has held the overnight cash rate at 1.5% since August of 2016, indicating that their monetary policy is attempting to hold steady interest rates. The interest rate in Australia is expected to be 1.5% by the end of this quarter, according to Trading Economics, and stay at that rate for the next 12 months. The US interest rate, on the other hand, is expected to go from its current standing at 0.5% to 1% by the end of March.
According to the RBA, inflation for the Australian dollar will increase to somewhere between 2 and 3%, which will be in target for the government. In comparison, the US will see it decrease to 1.9% by December end of the year, from a current inflation rate of 2.3%. This will leave the Australian inflation rate higher than the United States, meaning that there is less demand for imports and therefore less demand for the Australian dollar, and more demand for imports and therefore more supply for the Australian dollar. The United States inflation rate could see an increase, however, due to the hurricanes that have destroyed parts of Texas and Florida, thus increasing the need for relief and resources for importing goods.
Official intervention or government intervention is when a central bank tries to rectify or adjust something within the economy. In the case of exchange rates, this is usually done by manipulating inflation rates or raising and lowering interest rates, or releasing foreign reserves. Central banks usually have a policy regarding government intervention or What I meant was they usually have policies or regimes regarding government intervention. For example, the Fed has a free-floating exchange rate regime. A free-floating exchange rate regime is when foreign exchange markets set the price according to the supply and demand of other currencies in the foreign exchange. The RBA has a free-floating exchange rate regime as well. This has been in since 1999 and is usually intervened with using inflation rates. This means both central banks minimize intervention with their exchange rates, so it's not likely that they will make any changes.
In the short term, the next 3 months, the AUD-USD exchange rate will fall due to Australian interest rates being higher than the US interest rates. However, as the US interest rates increase up until April, the AUD will appreciate against the USD and the exchange rate will increase. As you can see on this graph from the NAB data, the exchange rate, although dipping and rising over the next 6 months, is expected to remain at the same level almost as it is currently. We will now look at the same determining factors except for the Australian dollar and Great British Pound exchange rate forecast. The interest rate data for the United Kingdom and Australia suggests that both rates will hold steady at 0.25% and 1.5% respectively. Australia's higher rate logically suggests that the AUD will appreciate against the GBP. However, exchange rates are made up of a number of determinants as we are discussing, and despite interest rates holding steady, the exchange rate is expected to initially decrease and plateau before the AUD appreciates against the GBP.
As talked about previously, the Australian dollar is As it's talked about previously, the Australian dollar is on target to reach its inflation goals, whereas the British pound is currently at an inflation rate of 2.9% and could see an increase of up to 3.2% by the end of the year. According to Samuel Toombs, a UK economist, the inflation rate may not increase as much due to the recent fall in global oil prices, thus reducing the cost for motorists and reducing the cost of importing goods. This would mean that the Australian inflation rate would be less than the British pound, which means there'll be more demand for exports and therefore more demand for the Australian dollar, and less demand for imports and therefore more supply of the Australian dollar.
Similarly to the Fed, the Bank of England has a free floating exchange rate regime as well, and hence is likely to avoid government intervention unless necessary. As mentioned before, the RBA is also a free floating regime, and as mentioned before, is unlikely to have any intervention unless absolutely necessary. Short-term changes in the floating exchange rate are usually the result of man-made influences and speculation and things like natural disasters, like Sam spoke about. If these are serious enough and are causing enough changes to the exchange rate in the direction that a central bank doesn't want it to go, that is when free-floating regime central banks will usually step in and try and rectify the situation. These issues are obviously hard to predict, so it's unlikely that the RBA or BOE will intervene. Continuing on from the point on natural disasters and current events affecting exchange rates, an example of this within the American exchange rate, the Australian dollar and the US dollar would be Trump and the North Korea situation at the moment. Trump, last year, according to the AUD news, his tweets were affecting the US dollar, and this is obviously a very hard thing to predict. So this could have an effect on whether or not the exchange rate appreciates or does not appreciate.
The NAB data also suggests that there will be an initial depreciation of the AUD against the GBP in the short term, roughly 2 months, but in the long term, over 6 months, there will be an appreciation of the AUD against the GBP higher than its current day standing point. This is supported by a lot of the data that we found. Other factors that are likely to have an effect on the exchange rates are as follows: commodity prices, economic growth rates, international speculation investment, and even the exchange rate forecasts themselves. These, combined with the three factors that we have talked about, will determine exchange rate forecasts. However, the forecasts are not always reliable, and there will likely be some difference or variance between the predicted and actual observed exchange rates.
Thank you for watching our presentation. Thank you and have a good one.